Hello there, I'm Erin. This is Boom Bust, and these are some of the stories that we're tracking for you today. First up, commodities. They took a beating Wednesday. Copper prices collapsed to 5.5-year lows, and we're going to tell you what this could mean for the global economy coming right up. Then Dennis Gartman will be joining me live on the show. The man behind the Gartman letter is sitting down with me to talk about capital markets. What an appropriate day to talk about that. And while commodities were getting sacked Wednesday, the collapse did lead to a global bond rally. Edward Harrison is going to be telling us all about this in today's Big Deal. It all starts right now. Wednesday, Bloomberg's commodity index fell to its lowest level in 12 years. Now, this comes after a rapid decline in the price of copper in after-hours trading on Tuesday took place. Copper hit its lowest level since July 2009, tumbling 5%. Now, the crash in copper prices is the latest in a global commodity sell-off that is being driven by a decline in the price of oil. Low energy costs make it cheaper for mining companies to increase production, while disappointing economic data from China is also adding to concerns about the demand for the commodity. The frightening thing, though, the really frightening thing, is that no one really quite understands why copper is declining so much and so rapidly. Here are two theories, however. One, cheap oil is creating a greater supply, and the drop in the price of copper is a result of speculation that cheaper energy costs will be encouraging mining companies to increase production. The second theory is that the demand for copper is going down simply because the global economy is slowing. The World Bank released a lower growth forecast for the global economy on Tuesday, which could also be pressuring the commodity as well. So could copper be the canary in the macroeconomic coal mine? Very possibly. The problem is we just can't identify which danger the copper canary is trying to warn us about. Scary stuff, but do stay tuned to find out. We're joined now by the always wonderful Mr. Dennis Gartman, publisher of the Gartman letter and capital markets expert. Welcome back, Dennis. I always love having you on the show. And I'd like to start off our conversation by asking you about commodities. Now, we sent you a chart of Dr. Copper earlier today that Joe Weisenthal of Bloomberg tweeted. Now, here it is. We're going to throw it up on the screen. Copper, another commodity, that's getting eviscerated. Boom. Or should I better say bust? What do you think, Dennis?
Yeah. Well, a lot of people look at copper and give it probably a little too much credibility as far as its ability to forecast economic circumstances. There's a lot of people on the street call copper Dr. Copper, as if copper has a PhD in economics. I will say that copper probably has a very nice bachelor's degree from a middle-ranking university. However, if you take copper, aluminum, tin, zinc, throw them all together, in aggregate, they may have a PhD in economics, because it wasn't just copper that was weak. It was all the base metals. They are all very weak. I suspect that they are telling you that, yes, economic circumstances are probably going to be weaker than almost anybody had thought. Yes, mining has been picking up because of the decline in oil prices. You talked about that. And three, let's not doubt for a moment that there's probably a large hedge fund out there somewhere that is liquidating under duress, getting rid of positions. I wouldn't be surprised if we find something untoward and very ugly having occurred. Too many people were far too long of commodities predicated upon an expectation of inflation, and I think a lot of people, I think somebody out there probably has had to throw their hands up and liquidate positions under duress.
Interesting. Now, what happened to the commodities bull market? I mean, is the slide in commodities about a strong dollar, or are we seeing something much, much, much more dangerous?
Well, I would say that probably 60% of it is the fact that the dollar is as strong as it is. putting downward pressure upon commodity prices. I would say that probably 20% is predicated upon expectations of a weaker global economy, and probably the last 10% is just specs getting taken out of long positions, because the specs, the speculators, are very rarely on the short side of any commodity. They're almost always a buyer. I've never understood that. I've only been at this now for 40 years, so I'm relatively new at it. But I still am amused at how everybody always wants to be on the long side of commodities, and I think people are just throwing their hands up, understanding that inflation is not the problem, that deflationary pressures are indeed the problem, and that's driving things down.
Now, obviously, speaking of booms and busts, we have to talk about oil. Oil is in something called contango, meaning the front near-term contract prices, they're higher than futures that settle later. Now, this incentivizes traders to store physical product to lock in prices. So can you tell me a little bit about the dynamics of crude storage and rising tanker rates? You know about this.
Yes, this has happened before, and it's happening right now. You now take a look at Brent, for example. The difference between front-month Brent and one-year forward Brent is almost 25%, i.e., if you took delivery of Brent futures, held the crude oil, and sold the deferred futures, you would make about 25 to 26% on your money. People are now taking advantage of that contango, and contangos occur when you have a large, an excess supply and far in excess of demand. Crude or whatever commodity we're talking about bids for storage. It goes into storage, and you have this circumstance called contango. With that as large as it is, people are actually going out buying old or leasing old tankers, putting the crude oil into it, selling the deferred futures, and locking in what looks to be like a relatively riskless transaction, so long as you have the tanker in place, so long as you have the borrowing capabilities to buy the amount of crude oil predicated or needed to fill that tanker, and you have the borrowing capabilities to fund margin calls along the way. But this is happening. There's probably now about 25 large tankers out there in the water that are being used solely for the purpose of basically sopping up the excess supply of crude oil that exists. And this is going to continue for a while, because clearly the Saudis are continuing to supply crude. Certainly we are continuing to supply crude. The Canadians are not about to shut off their crude production, nor are the Venezuelans. There's a lot of excess crude out there, and it's got to go someplace. It's either filling up tanks around the world above ground, or now it's putting pressure, it's filling up tankers on the water, which is reducing the supply of tankers needed to take crude oil around the world. So day rates for tankers themselves are going up, and those stocks are getting quite strong.
Such an interesting side effect. Now, Dennis, you're long tanker shares and gold, so why is that?
Yeah. Well, I'm long tanker shares for what we just explained.
Yep, that makes sense,
The supply of tankers is being reduced simply because they're going into the contango trade. So I'm long tankers. They got a little excited, I have to admit. Even I was surprised, because some of them went up in the course of less than 3 or 4 days. Some of them went up 100%. Some of them went up 75 or 80%. The last 2 days they've corrected decently, which is a good thing. So I'm back in buying tankers again. I've owned gold for several years, but not gold in dollar terms. I have no interest in gold in dollar terms. I have great interest in gold in euro terms, because I think the euro is going to be an ever weaker currency and an ever cheaper funding capability. I own gold in yen terms, which has been a wonderful trade for several years. I wish that I had had the temerity to buy gold in ruble terms, because that would have been the greatest trade of all, given the demise of the ruble. So I'm long of gold, but in currency terms that are weak currencies.
And what about the respective derivatives markets there?
Well, you can either put the trade on, you can buy gold futures and sell the interbank market rate in yen or euros, or you can go ahead and buy the ETFs that are listed on the New York Stock Exchange, GYEN or GEUR, gold yen, gold euro. The gold bugs don't like me, because they always want to be long of gold in dollar terms, because they're always expecting the dollar to go into some sort of chaotic demise. And so even though I've joined them on the bullish side of being bullish of gold, they have a hard time understanding why I want to be long of gold in non-US dollar terms. But there are derivatives out there that will afford you that trade.
Interesting. Now, Dennis, what's your view on the U.S. market? Are you bearish or bullish on shares?
I was bullish of shares, honestly, for quite some period of time until yesterday. We started to, I'm very simple. One of my favorite hedge fund managers, an old friend of mine, once said, sometimes it helps to think about trends as a 4-year-old would think about them. And if you hold a chart in front of a 4-year-old that's moving from the lower left to the upper right and say, what is this doing? They'll say, that looks like it's going up. Sometimes you need to take things simplistically that way. Hence, thus far, the stock market, until the past week or two, had been moving from the lower left to the upper right. It was constantly the proper thing to be a buyer, to look for weakness. But suddenly we've stopped doing that. Suddenly we're starting to break trend lines that have been extant for a long period of time. Suddenly we've stopped making new highs. Suddenly the stocks that really were the leaders, such as Apple, have refused to make new highs. So suddenly we're starting to do we're having detrimental circumstances prevailing as far as the psychology, as far as the technical circumstance of the market is concerned. Yesterday was a particularly acute day when you opened up as sharply higher as you did and then ended up the day lower, called a reversal day.
Yeah.
Today, again, we followed through on the downside. Yes, some are making a great good deal about the fact that we bounced hard from the lows, but I think damage has been done to the psychology of the market. I think damage has been done to the charts, and I think that the economy of the world is slowing down just a little bit, which is the fundamental reason why you're probably going to get some weakness in stocks. So I had been bullish until yesterday. I've actually gone quietly to the bearish side of the market, and the operative word here is quietly. Not extraordinarily yet, but the fact that we traded as badly as we have causes me some concern.
Dennis, we only have 30 seconds left, but I want to ask you, and this isn't a commodities question, but I'm curious, why have interest rates dipped so much when the U.S. economy has been doing relatively well? Do you have a view here?
Sure. First of all, the trend has been down for 30 years, and that trend hasn't stopped. Two, money is moving to the United States because it is still the best place for money, for frightened capital to move to, which is constantly going to put downward pressure upon rates. And three, we are in a deflationary circumstance around the world, so the rates can still go lower. And everyone you talk to, every smart guy, every smart woman thinks that rates are going to go higher. The contrarian says rates are going to go lower. Rates are probably still going to go lower.
Well, we'll have to wait and see. And Dennis, we will wait and see and bring you back on to talk about it, because you are one of my faves. It's always a pleasure talking to you. That was Dennis
Thanks,
Gartman,
Erin.
publisher of the Gartman Letter. Time now for a very quick break, but stick around because when we return, Mark Thoma will be on the show. The Fiscal Times columnist sat down with me earlier to talk about job growth, wage growth, and interest rate growth, if any. Then in today's Big Deal, Edward Harris and I are talking about interest rates and whether the recent drop in commodities prices is signaling default. And remember, you can see all segments featured in today's show on YouTube, youtube.com/boombustrt, and on Hulu, hulu.com/boom-bust. Now, as we go to break here or look at some of your closing numbers, don't go anywhere.
It was a terrible mistake, and we're working very hard to make up for it.
And once again, we put something on the air. It's a flat-out lie.
Have you ever had sex with Governor Rick Perry?
No, wait. Do not answer that. I want you to watch what we're about to do because you've never seen anything like this on television.
Right from the scene. First-rate news and eye-gripping pictures. on our reporters' Twitter and Instagram. To be in the know, follow us online.
Welcome to the future. Science, technology, innovation. All the latest developments from around Russia.
We've got the future covered.
Welcome back to the show. Up now is my interview with Mark Thoma. And Mark is a professor of economics at the University of Oregon, columnist at the Fiscal Times, and author of the blog Economist's View. Now, in 2014, U.S. job growth averaged about 240,000 jobs added per month. That's the best figure since 1999. So I first asked Mark if the U.S. economy is on the right track. Here's what he had to say.
It's on the right track, but it still has a long way to go. Even though the unemployment rate is 5.6%, I think there's a lot more slack out there in labor markets than that number indicates. And a big part of that is because we've had a lot of people leave the labor force, discouraged workers as they're called. And a lot of those people, I think, will come back as the economy improves, and that's going to make it much harder to get to full employment. So yes, things are looking up. It'd be nice if they were even more robust growth than we've seen, but it's been pretty good. But I still think we have quite a long ways to go.
And you know, what about inflation? How does the Fed meet its dual mandate on price stability and full employment when inflation is headed down, even as the U.S. gradually moves towards full employment?
Yeah, they're in good shape right now because both of their targets require an increase in the money supply, an aggressive stance of monetary policy. And so inflation's running below the 2% target, unemployment's still too high, and both of those things call for the Fed to be fairly aggressive and not to start tightening up. I think the real question is, when will inflation begin to show itself? And that'll depend in large part, I think, on wage growth. And I just don't think, as I said a few moments ago, that we're close to the point where labor markets are tight enough that we're going to see a lot of wage growth. Even when we do, there's a lag between when wages go up and when prices go up, usually a quarter or so. So even then, the Fed will have some time. So I think the Fed really needs to be patient and wait until it sees wage growth, sees prices starting to go up before it gets too excited about raising interest rates. Patience.
Patience. It's a virtue, I hear. Now, you know, everyone is talking about the prospect of Fed rate hikes this year. Now, your colleague, Tim Dewey, has told us that he sees the Federal Reserve hiking already in June, but Fed Chair Yellen has expressed concerns over poor wage growth. So what are the real issues here, Mark?
Yeah, I'm more with Kutcher, Lakota, and Evans, who would really like to delay rate hikes until 2016. The real issue is just we were just talking about. Inflation's running too low, unemployment's too high. That calls for an aggressive stance. What they're worried about, the big issue here, is there's a long lag time between when you change monetary policy and when it affects the real economy. So they want to start raising interest rates a little bit before they actually see inflation. So they're going to have to forecast, well, when will we see inflation? And I think what they need to wait for is some increase in wages, some sign that there's some pressure on markets to raise prices, and we're just not seeing that yet. So although there's a lot of people on the committee, the Plosier types, who would like to raise rates sooner rather than later, you know, the Dallas Fed president, also Fisher in the same boat, I think if they raise them too soon, and I think summer's too soon, that would be a mistake.
Now, you know, 10-year yields are at 180. So what are these declining yields telling us about the economy, Mark?
I think they're telling us two separate things. The first is that investors believe that the economy is weaker than perhaps some of the hawkish members of the Fed believe, and so rates are low. They're looking forward and saying, we're not seeing the Fed raising interest rates as soon as some people are saying, because the long-term rates ought to respond to an expectation that short-term rates are going up in the fairly near future. And so obviously that expectation isn't there, and that's an indication investors are seeing a weak economy pretty far out. But I think the other effect here too is there's also a fairly weak world economy, and the US, especially treasury bonds, treasury bills, are a safe haven. And so the demand for treasury bills and bonds has gone up as people search for that safe haven. And when the price of bonds goes up, the interest rate is held down. And so I think it's a combination of a weak economy, both in the US and in the worldwide, and also the fact that the US is a safe haven for when money sees trouble in other places.
Now, why are we even talking about the Fed, Mark? You know, is proactive use of fiscal policy just dead?
I think it is, especially with the Republicans taking over Congress. If we see anything, we'll see tax cuts, and maybe they'll try to push through some tax cuts to stimulate the economy. But in terms of spending, maybe a little bit on infrastructure, but I just can't imagine this Congress proposing major programs on the spending side in particular that would tend to boost the economy. And so I think fiscal policy is all but dead, except for some of the pet projects, like we say, tax cuts. But that's for other reasons, I think, ideological reasons, rather than trying to stimulate the economy. And so, yeah, I would think I would very much have to agree that it's dead.
All right, goodbye. Goodbye fiscal policy then. You know, 2014, it was the best year for the budget deficit since 2007. So is this a good thing that's a result of increased tax receipts in a flourishing economy, or is it a sign that fiscal policy has been a drag on growth?
It's a sign of both. Right now, the major effect, austerity sort of ended, and the cutbacks in government spending at the state and local and the federal level have pretty much ended. I think there's even some sign that's coming back a little bit. Initially, it was largely due to austerity and cuts in spending, and there's been a lot of that. But it's certainly also due to increased tax revenues from a recovering economy. And right now, I think the tax revenue effect is probably stronger than the austerity effect when you're talking about any changes in the deficit right now.
That's interesting. Now, Mark, recently efforts to cut corporate tax rates, they've met opposition from the last place that you'd expect it, businesses, not usually where you're going to get a lot of opposition. Now, apparently fewer and fewer businesses pay corporate taxes, so that closing loopholes and reducing corporate tax could end up increasing the tax bite. So what do you make of this?
I think our statutory rate is fairly high. When you look at the effective tax rates for the U.S. corporations, they're not as high relative to other countries as they might have first seem. But I think they are a bit too high. And so as a stimulus proposal, and I think the Obama administration's on board with this, at least some components of it are, a cut in the corporate tax rate wouldn't hurt and would be likely to help and might make us a little bit more competitive, keep jobs in the U.S. and that sort of thing. And so I understand what some of the corporations are afraid of. If they cut rates but broaden the base, some people are going to get hurt, and of course they're going to oppose it. But overall, I think it would probably be a good thing, not a hugely good thing. It's not going to turn the economy around or anything, but I think it's a move that would be worth making.
That was economist and columnist Mark Thoma. Time now for today's Big Deal.